Big thank you to Taxmann for providing me an opportunity for the today's webinar. Hello, welcome, and good evening to all of you for this today's webinar on capital restructuring, tax impact on company and shareholders. In next 55 minutes, we will deliberate our discussions on all the options that are available for the capital restructuring, which will impact on company and to the shareholders. And for last 5 minutes, I will take question and answers if any. So I will request audience to ask as many as questions and just type your questions in the Q&A, and we will take the questions and answer at the end of this session. So this is the agenda of the today's session. So we will discuss what are the options are available under the Companies Act as well as under the Insolvency and Bankruptcy Code while doing the restructuring. So we will due to the time constraints, we will focus on the company law. What are the options that are available, and if time permits, we will discuss the options available under the Insolvency Bankruptcy Code as well. So this is in the pictorial form. We can say that this is the agenda. So the capital restructuring we can do under the company law and under the IBC as well. So restructuring will impact both onto the company and to the shareholders as well. So our discussion will be mainly on the income tax side, right? So we will just touch upon the Companies Act, basic principles of the Companies Act, and mainly focus will be on the Income Tax Act, how it will going to impact onto the company as well as into the shareholders. So these are the options available. So we can say that there are these 6 options available while doing the capital restructuring under the Companies Act as well as under the IBC, which is the Insolvency Bankruptcy Code. So under the Company Act, we can say that we can further bifurcate into 2 parts. One is into the equity and one is into the debt or into the loan part. So under the equity, so we will discuss about the amalgamation or the mergers, demergers, slump sales, or restructuring through capital reduction or by way of buyback of shares. Or the company can do the restructuring while issuing the bonus shares or issuance of the new shares. What are the tax implications it would be? What would be the valuation principles that we need to adhere to while doing this capital restructuring? Then the options are also available, like the redemption of the preference shares as well as the conversion of the preference shares into the equity. Under the 5th part, we will discuss about the conversion of the loans into the equity. What would be the tax implications while doing this conversion of loan into the equity part? As well as there's a remission or waiver of the loans by the lender side. So how it's going to impact as an entity or as the organization for a particular company side. And the 6th portion, we will discuss about the resolution plans under the IBC. So IBC is a full-fledged chapter. So if the time permits, we will discuss the resolution plan as well. So now let's start our discussion one by one. So capital restructuring through merger, demerger, or by way of the slump sale. So under the Companies Act, so there's a sections called section 230 to 232, which prescribe the procedure how this amalgamation or the restructuring can be set aside by with the approval of the NCLT. There's a further 2 section 233 and 235, which is specifically for certain type of companies. So the idea is just to give the brief about how the company can do the restructuring as per the Companies Act with the NCLT approval. So these are the sections under which the company can do their restructuring part. So the idea is just to focus on the income tax side, how this Companies Act as well as this income tax both will play a very crucial role in terms of the restructuring part. But our focus would be on the income tax side for the today's discussion. So first option which is available for the company is the amalgamation or the merger. So in simple language, we can say that amalgamation merger means one company is going to merge with the another company, right? So that is simply a merger. So how this merger will impact both on the company and as well as the shareholders. So for the sake of convenience, I have prepared two types of slides. One is relating to the company, which is into the blue color. And for the shareholders, the slide would be into the brown color, just to differentiate between, just to say that we can differentiate between the company side as well as into the shareholder side. So firstly, we will discussing on the company side. So amalgamation basically has been defined under section 2 clause 1b, right? So amalgamation means, so we will just touch upon the relevant portion of the all the relevant definitions which will impact on the capital restructuring side, right? So we will not discuss about the carry forward of losses or the industrial undertaking definition or the block of assets or the depreciation part. We will just touch upon the relevant part which will be impact on the capital restructuring side, right? So for this amalgamation definition, which has been defined under section 2 clause 1b. So amalgamation means is exhaustive definition, which means merger of one company with the another company, right? To just form the another company. The condition that all the property of the amalgamating means the transfer company become the transferee company, means the amalgamated company. So transfer company is the amalgamating company, transferee company is the amalgamated company. All the liabilities of the amalgamating company become the liabilities of the amalgamated company, means the transferee company. Now the third one, which is a very crucial one, that shareholders holding not less than 3/4 in value of the shares become the shareholders of the amalgamated company. So when all the conditions are prescribed or fulfilled, so that means we can say that we have fulfilled the definition of the amalgamation as per the Income Tax Act. So as and when this Income Tax Act says that my amalgamation will be as per Income Tax Act, so section 47 says that any transfer in a scheme of the amalgamation of a capital asset by amalgamating company to the amalgamated company, provided that the transferee or the amalgamated company should be the Indian company, it will not be treated as a transfer. So that means it will be called as a tax neutral merger, as simple as that. So now the question is, what is the meaning of the capital asset? If all capital assets is going to be transferred by the amalgamating company to the amalgamated company, so that means it will not be treated as a transfer. So now what is the meaning of the capital asset? So capital asset means, which has been defined under section 2 clause 14, which also says that property of any kind held by an assessee. So property of any kind held by assessee means the property has not been defined under the Income Tax Act. So we can take the references from the judicial pronouncement. What is the meaning of the property? It can include all type of property, whether it's a tangible or intangible form. So what is the meaning of the transfer? Section 2 clause 47 says that transfer in relation to capital asset includes, because it specifies that it's an inclusive definition, sale, exchange, or relinquishment of assets, or extinguishment of any rights therein. So this is a very important one, the extinguishment of any rights therein, as far as the capital restructuring part is concerned. So what is the meaning of the extinguishment of any rights? As far as when the shareholder will transfer the shares from the amalgamating company to the amalgamated company, whether the same will be called as a transfer or not, we will discuss in the subsequent slides. So what would be the impact on the company side as far as the amalgamation or the merger part is concerned? So first of all, in the previous slides, we have discussed that it will not be treated as a transfer. So that means all type of capital assets, whether it's a tangible or intangible, by the transfer to the transferee company, provided the transferee company is an Indian company, it will not be treated as a transfer. So that means there will no any capital gain tax as far as the merger part is concerned. So now subsequently, what would be the further impact in terms of the cost of acquisition for the amalgamated company side is concerned? Section 49, subsection 1 says that whatever the property is acquired by the amalgamated or the transferee company, the cost of acquisition of the property of the amalgamated company shall be deemed to be the cost for which the previous owner of the property acquired it. So that means that whatever the previous owner's cost, so that will be deemed as the cost for the amalgamated company. Further, Section 2, clause 42A says that the period of holding will also be get included for which the capital assets were acquired by the amalgamating company, means the transferor company. So whatever the period of holding is by the transfer or the amalgamating company, that will also be get included. So section 55, subsection 2, clause B says that the fair market value option is also available if the property became the previous owner before 1st April 2001. The conclusion is that it will not be treated as a transfer, first of all. No tax will be payable by the transferor company as per section 47. And if any asset is sold by the transferee or the amalgamated company further in the subsequent years, whatever the cost of the amalgamating company, that will be treated as a cost for the amalgamated company, and the period of holding will also get included for the amalgamated company. Now, coming to the shareholder side, in terms of the amalgamation or the merger, what would be the impact on the shareholders? So shareholder means that I will hold the shares, right, in the particular company X, and due to merger, I will get allotted the shares of Y company. So now the question is, transfer of the shares by in company X to Y by a particular shareholder, will it be treated as a transfer? Section 47, clause 7 says that any transfer by a shareholder in a scheme of amalgamation of a capital assets being shares held by him in the amalgamated company, if the transfer is made in consideration of allotment of any shares. So that means if the shares are allotted, shares means it could be preference or it could be equity. It could be any type of shares. If I am getting the bonds instead of the shares, right? So that means it will not be treated as it will not be, I will not get any exemption in terms of the section 47. So that means it will treat it as a transfer, because the condition is that the transfer is made in consideration of the allotment to him of any share or shares. And the second condition is that the amalgamated company means the transferee company should be the Indian company. So that means it will not be treated as a transfer. Now the question is, in the previous slide, I have mentioned that the in the meaning of the word transfer, section 2, clause 47 say that any extinguishment of any rights, right? Any extinguishment of any right will be treated as a transfer. Now the question is, if a particular shareholder is getting the shares in the amalgamated company due to the merger of the amalgamation, it will not be treated as a transfer, right? It will not be treated as a transfer. Condition is that I am getting only the shares. There are the two judgments which prescribe that the allotment of shares by the amalgamated company to the shareholders of the amalgamating company means the transferee company to the transfer company shareholders, it will be treated as a transfer. There's a one judgment called Grace Collis, Mrs. Grace Collis by the Honorable Supreme Court, which specifies that transfer of the shares in the amalgamation is an extinguishment of any right. So that means it will be treated as a transfer. But due to the exemption which has been provided under section 47, it will not be treated as a transfer. Now, the second condition is that suppose I'm getting a cash instead of shares. So whether the same would be treated as a transfer? The answer is yes, because in this judgment, Grace College, the Supreme Court says that it will be treated as an extinguishment of any rights. Whatever the amount you are getting, it will be treated as a transfer. So that means either I am getting bonds or I am getting any cash. So it will be treated as transfer, and I have to pay the capital gain tax on it, right? So that's why this extinguishment of any rights is a very important in terms of the amalgamation part is concerned. There was a one more judgment called Rasik Manelal. There was a Supreme Court judgment in the earlier years, which specifies that the transfer of shares by the shareholders of the amalgamating company to the amalgamated company, it will not be treated as a transfer, right? But overruling that judgment in the Grace College, the Supreme Court says that no, it's an extinguishment of any right and it will be treated as transfer. So first condition is that it will not be treated as a transfer provided I am getting the shares in exchange of the shares for the shareholder part. The uh, the second condition we can say that, or the second part we can say that whether the deemed dividend will be applicable in terms of the merger part is concerned. So section 2, clause 22, which has specified the five sub clauses A, B, C, D, E. Clause C that says that any distribution made to the shareholders of the company on its liquidation, right? it will be treated as a dividend in the hands of the shareholders. So now what would be the implication in terms of the merger or the amalgamation part is concerned when two companies going into merger, one company is going to cease to exist. So there's a one circular which has been notified by the CBDT which specifies that in terms of the merger, right? So one company absolutely that it will going to be seized, but it will not be treated as a dividend because the company is going to be liquidated, right? But it will not be treated as a dividend in the hands of the shareholders. So no deep dividend will be applicable in terms of the as far as the amalgamation or merger part is concerned in the hands of the shareholders by the circular number 5 issued in 1967. So what would be the cost of acquisition in the hands of the shareholders while getting the shares in the amalgamated company? So cost of acquisition would remain the same as they were holding in the amalgamating company. Whatever the cost they have incurred in the amalgamating company, the same cost will get applied to the shareholders in the cost of the acquisition of the amalgamated company. And the period of holding, yes, the period of holding will be included for which the shares in the amalgamating company were held by the assessee. So if I am getting the shares into the after the amalgamation in the amalgamated or the transferee company, the period of holding will get also included and the cost of acquisition would remain the same as I have incurred in the previous company. So that means so far there is a no tax implication as far as the merger part is concerned in the hands of the company as well as in the hands of the shareholders. So it will be a tax neutral. Now coming to the demerger side, demerger is a bit more complicated as compared to the amalgamation. So demerge means hive of its one of the undertaking to the another company, provided that all the property of the undertaking become the property of the resulting company. One is the demerged company, one is the resulting company. Resulting means the transferring company, demerged company means the transfer company. Only condition is that the condition is that it should be transfer of the undertaking, right? Undertaking. So undertaking has been defined under the in the section 219 clause 2 clause 19 AA, and there are various judgments which specifies that what is the meaning of the undertaking as well. So condition is that all the property of the undertaking become the property of the resulting company. All the liabilities of the undertaking become the liabilities of the resulting company. The third, which is the main condition, is that shareholders holding not less than 3/4 in the value of the shares become the shareholders of the resulting company. The same condition. If I'm getting the shares in exchange of shares, so that means it will not be treated as a transfer. If I am getting a cash or bonds in exchange of shares, that will be treated as a transfer and it will not be treated as a tax neutral demerger. So this is the main condition. So the demerger has been defined under section 2 clause 19 AA. So it will so by fulfilling this definition of the demerger, so section 47 clause 6b defines that any transfer in a demerger of a capital asset by demerged company to the resulting company, if the resulting company is an Indian company, it will not be treated as a transfer. It will be tax neutral demerger. So same case as we discussed in the merger side, the same thing is mentioned in the demerger side as well. So it will be a tax neutral demerger. It will not impact on the company. It will be tax exempt in the hands of the company. So the same thing, capital assets we have discussed in the amalgamation slide. So same will get applicable. Property of any kind. Property means the property has not been defined. We have to take the judicial pronouncements for this or judicial references for meaning of the property. Yes, it include both tangible as well as the intangible. And the transfer definition, the same thing we have discussed. Section 2, clause 47, sale, exchange, or relinquishment of assets or extinguishment of any rights therein. The grace code is the judgment will be equally applicable in the terms of the demerger side as well. The cost of acquisition in the hands of the resulting company would be same. Section 49, clause 1, as applicable for the merger, the amalgamation or the merger part, the same will get applicable for the demerger side as well. Second thing is that the period of holding will get also included. Yes, as we discussed in the merger side, the same thing will get included for the demerger side as well. And the fair market value options will get available if the previous owner got this property before 1st April 2001. So now, what would be the impact on the shareholders? So yes, the transfer of the shares by the demerge by the shareholders in demerged company to the resulting company, it will be treated as an extinguishment of any rights as the defined in the Grace Collis judgment. Same will applicable for the demerger side as well. And section 47 clause 6D says that any transfer or issue of shares by the resulting company in the scheme of demerger to the shareholders of the demerged company, if the transfer or issue is made in consideration of demerger of the undertaking, it will not be treated as a transfer. If I am getting the shares in exchange of shares as per the swap ratio, it will not be treated as a transfer. First of all, if I'm getting a cash or other than shares as a consideration part, it will be treated as a transfer and the capital gain tax will get applied over here. So now, what would be the dividend implication in the hands of the shareholders as well as this demerger side is concerned? So in the amalgamation, there will be no deemed dividend, right, in the hands of the shareholders. In case of in case of the demerger side as well, there will be no deemed dividend. As per clause 5 of exemption clause of section 222, which says that any distribution of shares pursuant to demerger by the resulting company to the shareholders of the demerged company, whether or not there is a reduction of capital in the demerged company, dividend will not be applicable. So that means in case of merger as well as in case of demerger, in both the cases, the dividend implication will not applicable in the hands of the shareholders. And what would be the cost of acquisitions in the hands of the shareholders in the resulting company? In the merger in the case of the merger, the cost of acquisition as well as the period of holding will get included, and cost of acquisition would remain same as we have incurred in the previous company. In case of demerger, because in the demerger we will hive off one of the undertaking to the resulting company, the cost will get proportionated, right? So on the cost will get the proportionated in terms of the book value or the net assets net worth of the demerged company to the resulting company, as per the formula which has been defined under section 49 clause 2D. Period of holding, yes, the period of holding shall be included for which the shares in the demerged company were held by the assessee. So period of holding would also get included. The cost of acquisition will get proportionally reduced in the net worth as well as the net book value of the assets and the assets, and the same will get become the cost for the shareholders of the resulting company. So now the next question is whether the GAR will get applicable. GAR means the General Anti-Avoidance Rules as defined in section 95 to 102 for impermissible avoidance agreement. So the question is whether the GAR will get invoked if the arrangement is sanctioned by authorities such as court or NCLT or is in accordance with judicial precedents. Because this merger or demerger part of the restructuring is normally approved through the NCLT or the judicial authorities. So as per the CBDT circular number 7/2017 specifies that whenever the approval is getting through the judicial or through the NCLT, GAR will not apply for such type of arrangement because the court will see all the aspects relating to the commercial transactions, and for that basis, the GAR will not applicable. There's a one judgment in case of the Panasonic India, wherein it has been the income tax department want to apply the GAR at the time of the approval of the scheme itself. So the NCLT bench, Chandigarh has said that at the time of the approval, the GAR will not be applicable. But yes, the tax department is free to invoke GAR at the time of the assessment. They have the liberty to invoke the GAR at the time of the assessment. But yes, at the time of the approval, they have no authority to apply the GAR, right? So far, there's only one judgment which has specified that what would be the implication of the GAR. So the GAR will not applicable for the approval part of the scheme is concerned from the NCLT side. So I mentioned some judicial pronouncements which will be really relevant as far as the merger or the demerger part is concerned. So one is the Marshall Sons and Company, which specifies that what would be the appointed date for the amalgamation, right? So there was a Madras High Court judgment of the same Marshall Sons and Company, which specifies that the appointed date means the date of approval by the judicial authorities, High Court or the other authority. The overruling that judgment, the Supreme Court has specified that the appointed date means the which has been specified in the scheme. So it's a landmark judgment. CIT versus Rasiklal Maniklal, which specifies that amalgamation is not a transfer, which we have discussed in the previous slides. So overruling this Rasiklal Manilal, the Supreme Court in another judgment, Grace Collis mentioned that the amalgamation is an extinguishment of any right. So that means it will be treated as a transfer. McDowell case, we specify that what would be the difference, what is the difference between the tax planning versus colorable device. So how the merger or demerger a company can do while taking the benefit of the tax losses or some other incentive part. So how can we differentiate between the tax planning and the colorable device? Gautam Sarabhai Trust is a very famous judgment which says that if I am getting a consideration in terms of cash or in terms other than cash, so that means it will be, I have to pay the capital gain tax, right? So as defined in the definition itself, Maruti Suzuki case, which says that amalgamating company is ceased to exist. So no notice can be issued to the amalgamating company. So Indorama Textile, which has been specifically relevant for the undertaking definition for the demerger part. What is the meaning of the demerger? What is the meaning of the undertaking? Means if whether all the assets of the undertaking is required to be transferred or some assets can be left out. So it's a very relevant judgment per se for getting into the information how the meaning of the undertaking can be relevant as far as the demerger part is concerned. So I have mentioned all the judgments, relevant judgment, not all the judgments, the relevant judgments, which will be useful for the M&A part. So restructuring option under the slum side. So first of all, the slum side, I have just mentioned that slum side, we can't say that through the slum side, we can do our capital restructuring, but there is some history for this, for mentioning this slide in my presentation. So there is a two scenarios. One is that prior to Finance Act 2021 and post 2021. So there's a one judgment called Bharat Bijli Limited by the Bombay High Court, which says that, see, in case of slum sale, so I'm not going to discuss what is the meaning of the slum sale, which has been mentioned in section 2, clause 42C. It says that it means the transfer of one of the undertaking as a result of sale, right? Without assigning any value. Section 50B will get apply for the calculation of the capital gain tax. But now the question is, how this capital restructuring will be impacted due to this slum sale. So prior to 2021 Finance Act, the definition specifies that slum sale means transfer of one over undertaking result of sale. So the sale definition, which has been judicially pronounced by the one of the leading case in the Bharat Bijli Limited, means that the sale means only the sale consideration. If a company want to transfer its assets or the undertaking to the another company is issuing the shares in terms as a consideration part, so it will not be treated as a slum sale. So that means issuance of the shares will not be treated as a part of the slum sale. So to overrule these judicial pronouncements, the some amendment was brought into the Finance Act 2021, which specifies that the slum sale means transfer of one or more undertaking by any means. By any means that we can issue as a cash or any shares or any other thing as well, right? So in such transfer which we have discussed in section 2, clause 47, which means that sale, exchange, or extinguishment of any assets, right? Extinguishment of any rights therein. So that means in today's scenario, all type of the consideration, whether in cash or in kind, can be issued in terms of the slum sale part. So that's why I have introduced this slide in my presentation part, right? As in slum sale. So now coming to the next options which are available, capital reduction or by way of the buyback. So see in capital reduction part, so section 66, which has defined the procedure through the NCLT, right? So for the capital reduction, we have to go to the NCLT for the approval part. So reduction can be in two ways. First is that cancel any paid up capital which is lost or unrepresented by available assets. That means that suppose the company is having a heavy losses and they want to write off their losses in by way of the reduction of the share capital. Or the second thing is that pay off any paid up capital which is in excess in the bonds of the company, right? So there's the two ways through we can do the capital reduction, but only with the approval of the NCLT. The second option which is available under the restructuring part is that the buyback of shares. So buyback we don't need to go to the NCLT, right? But the criteria and the procedure has been defined under section 68. Some percentage or some existing conditions is required while doing this buyback as far as the company law is concerned. So what would be the implication under the Income Tax Act? So if I am going to cancel my paid up share capital, suppose I'm having a losses and I want to recover, I want to cover, or I want to adjust my losses into the share capital, right? So by way of the book entry, so there's no specific treatment as far as the company part is concerned. The second thing is that if I am paying off the share capital to the shareholders as an excess part, so that means the same thing, it's only the entry part. So nothing special treatment is mentioned or nothing special treatment is required for the company side as far as this capital reduction part is concerned. So now, for the shareholder part, suppose the company is doing the capital restructuring by way of the capital reduction through NCLT approval. Section deemed dividend implications will be applicable for the shareholders under section 2 clause 22 subclause D, which says that any distribution to his shareholders by a company on the reduction of his capital to the extent to which the company possesses accumulated profit, whether such accumulated profits have been capitalized or not. So up to the accumulated profits, whatever the distribution made by the company in the hands of the shareholder, it will be treated as a dividend. And now, 1st April 2020, the dividend is taxable in the hands of the shareholders. So now the question is whether the capital reduction by way of the capital reduction, suppose you are getting a cash or you are getting something as a shareholder in terms of the capital reduction part, whether it will be treated as a transfer. Yes, the answer is yes. The Honorable Supreme Court in Kartikeya Sarabhai case, it's a landmark judgment which specifies that capital reduction is a transfer and you have to pay the capital gain tax on it. And further, it is confirmed in the G. Narasimhan case as well. The capital reduction is a transfer and the liable to capital gain tax. The first thing is that you have to pay the dividend, and whatever the excess you are getting, you have to pay the capital gain tax. But procedure has not been defined in the Income Tax Act. In the G. Narasimhan case and the Kartikeya Sarabhai case, the Supreme Court has defined that whatever the amount you are getting, you have to pay the capital gain tax as well as far as the capital reduction is concerned, because it will be treated as a transfer under section 2 clause 47. So the another question is the tax implication on the shareholder part is concerned. If the company cancel the share capital, right? I'm not getting any cash or something from the company side. The company has write off the losses from the share capital and you have not getting anything. The companies have reduced their share capital. So whether the same will be treated as a capital loss in the hands of the shareholders? The answer is yes. Recently in the Tata Sons Limited case, Mumbai Tribunal, where it has discussed in a very detailed manner, relying on the previous judgment like the Kartikeya Sarabhai and G. Narasimhan and Kohli's Grace judgment, capital reduction is a transfer, is an extinguishment of the rights. And the loss on the reduction of the shares, because you are not getting anything, your loss, your capital has reduced substantially, means your investment has reduced substantially. So that means it will be treated as a capital loss. And the SECI has allowed to taken to treat this loss as a capital loss in the income tax part is concerned, right? So if you are not getting anything, So that means the capital reduction loss will be treated as a capital loss and it will be allowed in the income tax. Second part, buyback of shares. So buyback of shares, nothing is required, right? From the approval side is concerned. So, so that means from the company side, there's a section called Section 115 QA, which specifies that the distribution tax you have to pay at the rate of 20%. Whatever the amount will get distributed. So distribution, how the distribution or how the calculation, it's the same has been defined under the in the section itself. Now the discussion is the who will be liable to pay and who will not be liable to pay. The company is liable to pay, first of all, right? So tax on the distributed income to the shareholders, the buyback, listed or unlisted, the domestic company will be liable to pay, only the domestic company, right? At the rate of 20%. So buyback, they have defined. So they have introduced some changes in the Finance Act itself because the people were taking the advantage of that section. The buyback earlier, they defined that the buyback means purchasing their own shares as defined in Section 68, the Section 77 of the Erstwhile Act, right? So that means in that means only and only in that case, if I am reducing my share capital through Section 68 by way of approval, the company have to pay the distribution tax as per Section 115 QA. But the people were taking the advantage because we will discuss in the subsequent slides what was the rationale for introducing these changes, right? So in 2016 onwards, they have replaced that any buyback. So what is the meaning of the any buyback? So any type of buyback, whether it's through NCLT or Section 68 or some other section as well, because there is some one judgment why they've introduced the changes. The rationale for changes, making the changes is that there are two judgments called SEBI versus Sterlite and Capgemini case. The Bombay High Court mentioned that it's not mandatory for the company to buy back its shares only by following the procedure, which has been mentioned under Section 77A or Section 68 of the Companies Act, right? They can do the capital reduction by way of the rearrangement, which has been mentioned under Section 230 to 232, or the erstwhile Section 100 to 104. So for people who are taking the advantage of that section, they were introducing their capital by they were reducing their capital reduction by way of making the arrangement to Section 230 to 232 or 100 to 104 of the erstwhile act. So that's why they have introduced a change that changes that any type of buyback. So any type of buyback will be included in the distribution tax. So any buyback the company have to pay, right? So in the hands of the company, you have to pay the tax at the rate of the 20%. So now the question is, we are discussing about the tax implication for the company side. So any impact on the company as far as the section 56 to 10 is concerned, right? 56 to 10 is concerned. We say that any consideration become or any property which become the property of the buyer and which I am getting less than the fair market value, it will be treated as a income from the other sources. So now the question is, I am getting the shares buyback. I am buying back my shares as a company. So whether the buyback by way of the buying the shares back, would the section 56 to 10 will get applied? So there is a couple of judgments which defines that. Property means the shares which is in the existing form. But I'm buying the shares back means the shares are not in the property form. The shares is ceased to exist. It's not my property. So that's why section 56 to 10 is not applicable. The first judgment made by the Gora Financial Services, and this judgment was followed in the various other couple judgments like the Delhi Tribunal in Globe Market and VITP Private Limited, right? So 56 to 10 is not applicable as for the buyback is concerned in the hands of the company. What is the implication for the shareholders? Section 10, clause 34A defines that any income arising to the assessee being a shareholder on account of buyback of shares will be exempt, right? So section 10, clause 34 says that it's exempted income. So, but there is one another section which has been specified, that section 46A, capital gain on the buyback of shares. So post the implementation of section 115QA, section 46A has no relevance, right? So that means it is purely exempt in the hands of the shareholders. So now coming to the third part, restructuring option under the issuance of the new shares. Issuance of new shares, it could be new shares, bonus shares, or quasi-equity. So first, we can discuss about the issuance of the new shares. As a restructuring part, a company can issue the new shares as well, right? New shares, we have to apply the SEBI procedure or the company law procedure. But in terms of the Income Tax Act, so as and when the new shares will get issued, there's a one section called Section 56(2)(7)(b). It's specifically for the private companies. So this section says that where a company not being a company in which public are substantially interested, which can, in short, we can say that the private companies received in any previous year from any person being a resident any consideration for issue of shares that exceeds the face value of such shares. The aggregate consideration received for such shares as exceed the fair market value of shares will be treated as other income. So we have to comply the fair market value rules, which has been defined under section 11U and UA, right? So any shares which exceed the fair market value shares, fair market value shares means that we have to look into the 11UA rule. If it exceeds, it will be treated as a part of the other income. So now there's one amendment they have introduced in the last year budget 2023 from this year onwards, first for to 2024. So every person will get included, whether it's a resident or non-resident. Earlier it was only resident. Now it is only now all type of the persons, whether it is a resident or non-resident, right? So we have to comply the FEMA rules as well while issuing the shares to the non-resident parties concerned. So we have to comply the 56 subsection 2 clause 7B for taking the guidance of the fair valuation rule of 11U and UA. So one question is that there is one section called section 68, which says that any sum found credited in the books of account of the assessee, right? Against which no explanation is given to the assessing officer, the entire income, entire credit will be treated as a part of the unexplained income. So there's section called 56(2)(7)(b). So is there any interplay between these two? So this case, like Sunrise Academy, which has been elaborately discussed in by the Kerala High Court, we specify that the both sections are independent. Section 56(2)(7)(b) says that the consideration which is in excess of the fair market value will be treated as an income. Section 68 says that entire credit will be treated as an income. If no explanation is received by the AO from the assessee side, entire income, entire credit will be treated as income, like share application money or share capital, including the share premium part. But 56(2)(7)(b) says that if it exceeds the fair market value, the difference between the fair market value and the amount received will be treated as a part of income. So that means both sections are independent. So there is no any interplay between the 56(2)(7)(b) and section 68. So while doing the issuance of the shares, there's a one section called section 79, which specifies that carry forward and set up for the losses. We have to see that section as well while issuing the shares. Why? Because section specifies that 51% shareholding should remain the voting power. Who beneficially held the shares should remain the same. There is some exception for the startup companies. This specifies that in case of the startup companies, the shareholders would remain same, right? Shareholders would remain same. So while doing the restructuring, we have to analyze the situation whether 51% shareholding would remain same or not. There's a two type of school thoughts in terms of this capital restructuring part is concerned, as well as the carry forward of losses. One thing is that wherein if I am a part of a group and I am a holding company and I am having a three subsidiaries under my umbrella. If I am a holding company, I am transferring one subsidiary shares to the another subsidiary shares. This is a one school of thought that the section 79 will not get applied. Why? Because ultimately the beneficiary is held by me. The another school of thought says that, which says that no, section 79 will get attracted as and when the shareholders will get changed. Although you are part of the one umbrella, like you are part of the same holding company, so you have to comply the section 79 compliances. So there is two schools of thoughts. One is the AMCO power system and another is the Yum restaurant cases. So both working on the different scenarios. So we have to look these scenarios as well. The third condition is that if I am converting the quasi equity into the equity part, right? Like CCDs, I'm converting into the equity. So whether the section 56 7B is applicable, I have already issued the CCDs, and now in the current year, I am going to convert the CCD into the equity part, whether the same will get applicable. So there's a one judgment by the Kolkata Tribunal in case of Milk Mantra Diary, which specifies that the consideration is a very wide meaning. Consideration means any type of consideration. So that means at the time of the conversion as well, we have to comply the section 56 to 7B clause as well. So that means we have to comply the fair valuation rules at the time of the conversion as well, right? So it's basically a part of the legal interpretation. What is the meaning of the consideration? So if I am, as per this judicial pronouncement, if I am going to convert my quasi equity into the equity part, so that means I have to comply the Rule 11 UA as well as the section 56 to 7B compliances as well. There's some scenarios wherein we can say that in terms of the issuing of the shares. So there are the two options which says that the assessee has an option to choose the method, sorry, at which method they want to adopt or which method they want to choose while valuing the shares, right? So rejection of the DCF method without finding fault in the valuation report and substitution of the net asset method is not allowed. So that means if I am choosing as a DCF method while issuing the shares and the assessing officer want to replace the DCF with the net AV, NAV method, it's not allowed. So there's a couple of judgment I have mentioned. The another thing is that the DCF is basically on the projection side. So at the time of the assessment, the actual numbers will be available, and the AO has no right to substitute the actual numbers with the forecasted numbers. So that means it's not a rocket science for the valuation per se. So valuation, whatever the forecasting number that have taken, we have to rely on that, and we can't replace the actual number at the time of assessment with the forecasting number. So there's a couple of judgments we supported this school of thought. So for the issuance of the shares, what would be the implication on the shareholder side, right? So cost of acquisition of the new shares, whatever the amount I will pay, so that will be section 55 to close AA has mentioned that whatever the amount that I paid, that will become a cost for the new shares. Cost of acquisition of the bonus shares, it would be nil. Period of holding calculated from the date of the allotment. At the time of the sale, you have to pay the capital gain tax, right? Subject to the provision of section 50CA, which says that if I am selling the unquoted numbers, I have to take the value of the fair market value, which has been defined under section 11 UA rule. Bonus shares issue. So I can do my restructuring by way of the bonus shares, no impact on the company. It will be only a accounting entry for capitalizing it my profit. So it will be no impact on the company. For bonus shares in the hands of the shareholders, so we have to see the dividend implications. Whether the dividend implication would be there, the answer is no. The section 2 clause 22 subclause A says that the distribution doesn't partake the form of payment of the accumulated profit in cash. So that's why the deemed dividend implication would not be applicable as far as the bonus share is concerned. So two judgments I mentioned, Dalmi Investment and Shashibala Navital. Uh, 56 to 56 section 210 will get apply if I'm getting a bonus share. So recently, Delhi Tribunal has held a case that in Aruna Chandok that in case of the bonus share, section 56 will not be applicable for the, as far as the issuance of the bonus shares in the hands of the shareholders part. So fourth part is the restructuring option under the redemption or the conversion side, right? So redemption of preference shares, as far as the company part is concerned, there is a no impact, right? No impact on the conversion, on the redemption of the preference shares. Conversion of the preference shares into the equity. Whether any implications, the answer would be no, because but yes, in case of the one judgment which we have discussed in the previous slide, in the milk dairy case, which says that at the time of the issuance, at the time of the conversion, that will get applicable, right? So otherwise, there is a no any implication on the redemption part. So redemption of preference share is a transfer. When we discuss about the redemption in the hands of the shareholders, the answer would be yes. In the Anarkali Sarabhai case, the Supreme Court has mentioned that it's a part of sale, because redemption is a sale, and the company is getting the shares back. Uh, so that means it's a part of sale. And accordingly, if I am getting something lesser as compared to the face value, so that means whether the capital loss will be allowed, the answer would be yes, the capital loss will be allowed, as per the Parle Biscuit case. So, in there's a one judgment in Anzen Global Solution which specifies that if suppose in the at the time of the redemption you are getting some sort of premium, right? 1,000 value and you are getting 1,250. So, what would be the tax implication of this 250 which you are getting extra? So, the tribunal says that it's a part of capital gain, right? Because the redemption is a transfer and it will be treated as a part of the capital gain, and whatever the access you are getting into, it will be treated as a part of the capital gain and not as a part of the income of the other sources. Conversion of the preference shares impact on the shareholders. Conversion of preference shares, it will not be treated as a transfer in the hands of the shareholder. So that means the conversion of preference into the equity. Section 47, clause 10, 10b says that any transfer by way of the conversion of the preference share or bonds, it will not be treated as a transfer. So at the time of the capital gain, the same theory will get apply. Period of holding, in period of holding, and the cost of acquisition would remain the same, right? So whatever the cost you have paid at the time of the preference shares, and now you are converting the shares into the equity. So the cost and the period of holding would remain the same. The fifth portion is that capital restructuring through conversion of loan into equity or waiver of loan into equity, right? So conversion of loan into equity. So that means if I am holding a debt and I want to convert the debt into the equity side, so what would be the implication? In the IBC company, in the insolvency cases, right? Like, or in the case of the special stress case type of cases, stress company cases, that a company want to convert their loan into the equity, lenders want to convert the loan into equity. What would the tax implication? Yes, it's allowed. But sections 269T, which says that, which mandated that loan or deposit had to be repaid by the account paycheck or electronic mode, right? So that means the question arises for determination is whether the conversion of loan into equity can be said to be contravention of the provision of section 269D, because in the today's scenario, so it's a usual practice that everybody want to get converted the loan into the equity part. So that means there is any contravention of the section 269D. The answer would be no, because as per the judicial pronouncement, the answer is in favor into the assessee, which specifies that the transaction with respect to the conversion of loan into the equity carried out by the taxpayer through book entries. It's only a book entries. There is no any actual cash outflow. So that means the section is not get applicable, and there will be no any penalty. For section 270E, we specifies that in terms of the contravention of section 269D, you have to pay the penalty. So there is no any penalty will get be leviable. So yes, it's allowed. The restructuring can be done by way of the conversion of the loan or debt into the equity part. So the next option is the waiver of loan. So it's a very lengthy topic. I can discuss in next 5 minutes only, because we are a shortage of time. Uh, so waiver of loan means that suppose a lender has lender wants to waive off your loan, right? So in terms of this is specifically the in happened in the IBC companies insolvency cases. 1,000 loan and come and they want to restructuring or by pay of 400 and they want to waive off by way of 600, right? So what would be the implication of the 600? So waiver of loan, there are the three sections which can say that section 41, section 28, clause 4, and section 194R. So section 41 says that where an allowance or reduction has been made in the assessment of any year in respect of loss, expenditure, or trading liability incurred by the assessee, and subsequently during any previous year, the first mentioned person has obtained. The question is in terms of loan, whether I have taken the loss allowances or reduction. The answer is no. So whether the section 41 is applicable, the answer is no. So as settled in the Mahindra and Mahindra case as well by the Supreme Court, section 41 is not get applicable in terms of the waiver of loan part is concerned, right? So now the another criteria is section 28 clause 4, which is there is a two scenarios, section 28 clause 4. The Pre-Finance Act 2023 and Post-Finance Act 2023. So Pre-Finance Act 2023, so it has three limbs basically. Benefit or perquisite should arise to the recipient, should arise from the business or exercise of profession, and whether convertible into money or not. So this third limb is very important, whether convertible into money or not, right? So I will not discuss what is the meaning of the benefit, right? What is the meaning of arising? Yes, what is the meaning of benefit or perquisites? The second condition is that it should be arising from business or profession. So waiver of loan, right? Waiver of loan can be linked to the business or profession. Suppose I am into the manufacturing sector and the lender, like suppose SBI Bank has waived off my loan through the some condition. So whether the waiver of loan can be linked with the arising from the business or profession. This is the one scenario. Second scenario is that I'm into the loan business, like in the NBFC or the financial institution, and some lender has waived off the loan. So whether this condition of this waiver of loan by the lending company of the financial institution can be treated as an arising from the business or profession. So both conditions are different. So we have to see the arising from the business or profession. In the first case, it's not arising from business and profession. In the second case, yes, should be arising from the business and profession. There's a one very important judgment of Chetan Chemicals, which says that in case of the waiver of loan, if I am not into the business or profession, it will not be part of section 28 clause 4, right? So the condition is that it should be arising from business or profession. The third condition is that whether convertible into money or not. The Mahindra and Mahindra judgment, Supreme Court says that waiver of loan is a cash component. So as per the legal interpretation, they define that whether convertible into money or not means it should be in kind only. In kind only. So other than shape of money, right? So that's so only and only the in kind part will be covered under section 28 subsection 4. To overrule the Mahindra and Mahindra, they have introduced some amendment in section 28(4), which specifies that the convertible into money or not, in cash or in kind, or partly in cash or partly in kind. They have introduced the section by way of the amendment that whether the benefit arising from business through convertible into money or not, or in cash or in kind, both will get be included. So they have overruled the judgment of the Mahindra and Mahindra. So now, earlier there was a three limb, now it has a four limb. The fourth limb is that in cash or in kind, right? So they have mentioned in the section itself. Now the question is that so that means every kind of loan will get treated into section 28 subsection 4 because they have introduced the amendment, whether it's a cash or in kind. The Mahindra and Mahindra judgment, the court says that the loan part, waiver of loan part is a cash component. So that means cash component means every time of loans remission will be part of section 28(4). Because the Chetan Chemical case, the Gujarat High Court says that waiver of loan should be arising from business profession. So that means all type of loan will not be covered under section 28 subsection 4, clause 4, sorry. it should be a rise from business or profession. Had I been into the NBFC company and I'm getting a loan waiver, so that yes, it will be part of. If I'm into the manufacturing, it will not be part of as per the judicial pronouncement. So we have to see all the legal aspects for the waiver of loan application. So section 194R, which says that we have to deduct the TDS. So TDS in terms of the loan waiver part as well. So they have mentioned that one-time loan settlement by the specified institutions would not be subjected to tax, but there is some clarity is required. What would be the waiver of loan other than the specified borrower? So that means there is some still open questions as far as the TDS part is concerned, right? So I'm jumping into the main part. Waiver of interest, I'm not going to discuss this because it's a very simple thing. I can discuss this, the loan accounting treatment for the waiver of loan part. So waiver of loan part, we can say that there's a two type of standards, accounting standard. One is the Ind AS, one is the accounting standards. India says that 109 says that under the accounting standard, we says that yes, you can take into the capital reserve part for the waiver of loan part. But India says that waiver of loan can be routed through the P&L part, right? So there's a difference in the accounting treatment in accounting standard as well as the India's part is concerned. So I think I can, the IPC is a very a detailed topic, so I can take 2 minutes more just to define what is the meaning of the IPC to do the restructuring plan. Otherwise, it will take more. It will take another half an hour. So I will take just 2 minutes, 2 to 3 minutes more, just to define the meaning of the resolution plan under the IPC. So we can do the resolution plan restructuring under the IPC as a resolution plan. Resolution plan means section 5, clause 26 defines that, of the IBC code defines that. Resolution plan means a plan proposed by a resolution applicant for insolvency resolution of the corporate debt as a going concern. Right. So as a going concern, the plan is given by the resolution applicant to the insolvency professional to the which will be defined in the committee of creditors. So through that way we can do the corporate restructuring as well. So under the explanation part, they have defined that the resolution plan may include the option of the merger, demerger, or the amalgamation, right? So they have defined all the thing. Section 31 says that if the adjudicating authority is satisfied that the resolution plan is approved by committee of creditors, so the resolution plan is approved by the committee of creditors, and the resolution plan, if approved, is binding on the central government or every statutory authority, right? So resolution plan will be binding on the tax authorities as well. There's a couple of judgments, right? So through this way, we can do the restructuring of the resolution plan under the IBC code. There's another slides as well. I think that will require another half an hour. So I am now taking the pause and taking the questions and answers, if any. The question is, in case of a company which has a real estate asset, which has a real estate asset which is earning rent, can it demerge into the three companies, be tax neutral, mainly from the definition of the undertaking? See, the definition has been defined under the section 2, clause 19 AA, right? What is the meaning of the undertaking? Undertaking means that an undertaking which can run its business independently, in your case, if I'm into the real estate sector or real estate company, if I'm earning a rent, if I can prove that, okay, this type of the asset, through this type of assets, I can run my business independently. Yes, I can do the demerger, whether it's three part or in four part. So Indorama textile judgment is a very landmark judgment which defines that what is the meaning of the undertaking, right? What is the meaning of the undertaking? So yes, the answer would be yes, in my opinion. The company can demerge its business. So another question is there any contradiction regarding conversion of preference shares, milk mantra versus exemption? See, there is no any contradiction in terms of the conversion part. First of all, conversion will not be treated as a transfer. Section 47 says that it will not be treated as a transfer. Section 5627B says that in terms of, because it talks about the shares part. Shares means whether it's a preference shares or whether it's a equity shares. So at the time of the conversion of the preference shares into the equity, section 56(7)(b) will not get applicable. It will be applicable only and only in case when we will convert the CCD into the equity part, right? So I hope I have clarified this answer. I have given this answer. Is there any special tax treatment for the transfer of the unlisted share by resident to non-resident? For transfer of the unlisted share by resident to no, there's no any special treatment. We have to comply the FEMA guidelines, but under the section 56(2)(7)(b), which has specified both type of transfers, whether it's a resident or non-resident, all type of the persons will get included. So we have to comply only the FEMA guidelines. Yes, in from 2023, 1st September 2023, they have defined the five prescribed method for the valuation of the non-resident. So we have to comply that valuation rules as per section as per rule 11 UA. Any chance the PPT will share? Yes, the PPT will share. Can we get the copy of the presentation? Yes, the Taxmann team will share the PPT after this session. So have done. I've done my presentation. So any type of query further, you can reach out to me or to the Taxmann team. So thank you very much to the audience as well as to the Taxmann.